Hello, and welcome to today's episode where we're diving into the exciting world of passive income. Now, if you're like me, the idea of earning money while you sleep sounds pretty fantastic, right? But here's the catch. Not every passive income opportunity is created equal. Today, I'll be guiding you through how to evaluate these opportunities with an eye for long-term sustainability. Over the years, I've tested various solutions and analyzed market trends. And my aim is to help you make informed decisions that stand the test of time. Let's start by acknowledging how much the landscape of passive income has evolved in recent years, thanks in no small part to technological advances and shifting economic conditions. What worked back in 2020 might not be the best playbook for 2025. Understanding these changes is crucial for building an income portfolio that can withstand market volatility and economic uncertainty. So, what are we comparing today, and why does it matter? I've zeroed in on 4 popular strategies: real estate crowdfunding, dividend investing, digital products, and peer-to-peer lending. These 4 avenues are widely discussed within the passive income community and offer diverse paths for generating sustainable income. Each comes with its own set of benefits and challenges, making them perfect candidates for a deep dive into what really works in today's market. These strategies also represent different risk profiles, time commitments, and capital requirements. This gives you a broad spectrum to choose from, depending on your personal circumstances. And here's the beauty of it. Many successful investors don't rely on just one approach. Instead, they create a balanced mix that leverages the strengths of each while mitigating individual weaknesses. Let's jump into the analysis by looking at initial investment and scalability. Real estate crowdfunding often requires a significant upfront investment. Platforms like Ground Floor let you start with as little as $100, while others like Yield Street might require $10,000 for certain deals. But here's the kicker. The global real estate crowdfunding market was valued at $16.24 billion in 2024 and is expected to hit $22.1 billion by 2025. This shows a significant appetite from investors, driven by increased institutional participation and the democratization of real estate investing through tech platforms. On the other hand, dividend investing can start small, which makes it incredibly accessible. Some brokerages even offer fractional shares for as little as $1. However, building a substantial income stream takes time and patience. To put it into perspective, the S&P 500's dividend yield was around 1.25 to 1.37% in late 2024 and early 2025. Which is lower than its long-term average. So you might need a sizable portfolio, often between $500,000 to $1 million, to generate a significant income. While the scalability is linear with your investment, dividend growth over time can be remarkable. Many stocks have increased their payouts for over 25 consecutive years. Now, when we talk about digital products, they truly shine in terms of scalability with remarkably low initial costs. Often, all you need is time and creativity to start. Success hinges on finding the right niche and delivering genuine value to your target audience. It's a fascinating market, valued at $560 billion in 2024, with online games and virtual goods capturing a significant share. The potential for exponential returns is immense. Imagine creating a course that costs just $500 to make, but could generate millions in revenue if it strikes the right chord with your audience. Then there's peer-to-peer lending. It typically has a moderate entry point, with most platforms letting you invest from $25 to $1,000 per loan. Scalability is directly linked to your reinvestment strategies and borrower reliability. Interestingly, the P2P lending market hit $139.8 billion in 2024 and is projected to reach $1.38 trillion by 2034. This explosive growth is fueled by the increasing acceptance of alternative lending solutions and the growing gig economy. Next, Let's talk about risk and stability. In my experience testing both real estate crowdfunding and peer-to-peer lending, I've found real estate offers relatively stable returns, though market fluctuations can impact it. The average internal rate of return for real estate crowdfunding was about 10.6% in 2024. However, projects running over 6 months behind schedule have increased. This highlights the importance of platform due diligence. Geographic diversification can help mitigate regional market risks, and some platforms even offer secondary markets for improved liquidity. Dividend investing is generally stable but can be affected by company performance and broader economic trends. While S&P 500 dividend payments increased, the overall growth has slowed compared to the robust years prior. Stability comes from investing in established companies, but even those can cut or suspend payments during severe economic downturns, as we saw during the early pandemic days. Digital products carry high initial risks due to market validation challenges, but once established, they can stabilize beautifully. Once you've built a solid product and audience, ongoing risks diminish significantly. However, they face unique challenges like platform dependency, technological obsolescence, and changing consumer preferences. The key to stability is building a direct relationship with customers and continuously updating your offerings. As for peer-to-peer lending, it carries significant risks due to borrower defaults. While some platforms maintain stable default rates in 2024, the industry-wide data shows P2P loans had a much higher average default rate compared to traditional bank loans. Diversification is absolutely crucial here. Spreading investments across hundreds of loans and various risk grades can help smooth out potential losses. There you have it, a comprehensive evaluation of 4 promising passive income strategies. Each has its unique advantages and challenges, and the key is to align them with your personal goals and risk tolerance. Whether you're drawn to real estate's potential for stable returns, the long-term growth of dividend investments, the scalability of digital products, or the high growth potential of peer-to-peer lending, there's something out there for everyone. So as you explore these opportunities, remember that building a diversified, resilient income portfolio takes time and careful consideration. Don't chase every shiny new trend. Focus on strategies that align with your financial goals and risk appetite. Thank you for joining me today, and I hope you found this deep dive into passive income both informative and inspiring. Until next time, happy investing.